Hello guys, so we're back. Now the next topic that we will take a look at is auditing and stewardship is what we'll start at. Now we're looking at the theoretical topics in this course. So let's first understand what is stewardship. Now firstly, with large limited companies, there is a major issue. Like for example, if I talk about a sole trader, I know there is one person, he is the owner and he will run the company. With partnership, there can be a couple of partners and they can decide to run the company. But with large limited companies, there can be thousands and millions of shareholders, right? Now, we cannot have a situation where thousands and millions of people will come and run the company. This way, there will be no decision making process. Especially, let's say you can have a shareholder for Apple sitting in Bahrain, you can have a shareholder for Apple sitting in Singapore, but they will not come and essentially make the decisions, right? And it's not humanly possible. So, what we have to do under large limited companies is called the process of stewardship. You guys must have seen this in other courses as well. Now, what is stewardship? This diagram can help you explain the process of stewardship. So, shareholders who are the owners of the company, they delegate the task of their decision making process to the board of directors. Now, do you guys know what board of directors are? So, the board of directors are elected by the shareholders in the annual general meeting. So, just like we have elections for our parliaments, we also have elections for limited companies where different shareholders participate, and those who win the elections can be part of the board of directors. Right? Companies can have board of directors from 11 to 17 people, or there can be more, there can be less as well. But these board of directors are essentially delegated the task to manage the day-to-day operations and different decisions for the business on behalf of the shareholders, and they as a result also oversee the management as well, right? So the management is responsible to the board of directors, and the board of directors in turn are responsible or accountable to the shareholders. So the word steward over here comes from the fact that a person has been given the responsibility to take care of the resources and make decisions on someone else's behalf. Right? So that stewardship role is being played by the board of directors. They are stewards for the shareholders and they're taking a look at the management and the overall operations of the company. Right? So you guys should know what stewardship is. Now, another issue arises. What is that issue? We know that since the board of directors are amongst the shareholders, right? So think of this like shareholders can be in millions, but there are 10 or 11 people running the company. Now, these guys are essentially responsible for preparing your financial statements. They're taking different financial decisions as well, and these financial statements are then presented to the shareholders and the public. So there can be a possibility that the board of directors can be biased while preparing the financial statements to show a good picture to the shareholders, right? There is a possibility for that. So the shareholders or even the general public or investor, someone who's looking to invest in this company, would need some sort of credibility or an independent check or a verification that the financial statements that the board of directors have presented and all the decisions that the board of directors have taken have been for the interest of the shareholders and the value maximization. So you wouldn't want the board of directors to pursue strategies which will help them in their own personal benefit but not help in the objective of value maximization for the company, right? So since the board of directors themselves are presenting the financial statement, we need a verification or an independent check over here. That verification and independent check, if you guys think of, comes from an auditor. Now, what is an auditor? You guys would have heard this word, but now we will study what is an auditor. So the auditor is someone that is hired by the shareholders. Remember, the board of directors can recommend them, but they are hired by the shareholders, and the auditor is only answerable to the shareholder. Now, what does the auditor do? The auditor gives an independent view on the financial statements that have been presented by the board of directors. So the auditor will only give an opinion. Remember, he is not responsible for preparing the financial statements. The financial statements are being prepared by the board of directors, but the auditor will give an independent view over here that the financial statements that have been presented by the board of directors and the company show a true and fair picture. All right, so that picture can be reliable, the investors and the shareholders can believe that picture. Right, so to give that opinion, we hire someone called an auditor. Right, so auditor steps into this diagram over here as an independent check hired by the shareholders to see the work that has been done by the board of directors so that he can give an opinion to them. And in order to make sure that the auditor's opinion is credible, we need to ensure that the auditor, number one, is qualified, has sufficient technical knowledge, right? So that is why chartered accountants are auditors, right? So when you look at the big four firms, PwC, KPMG, Deloitte, and others, these are qualified chartered accountants. So the company would hire them because they are qualified, they would have sufficient knowledge about accounting and the taxation law, and they would be able to give an opinion based on that. The second requirement is that the auditor also has to be independent, right? So we cannot have a situation where we hire an auditor who turns out to be a relative of the board of director, right? In that case, there will be no independence, and you can think that the auditor's opinion can also be biased. Remember, we are looking for an unbiased opinion that can only come from a qualified auditor and someone who's independent. So that's the role that auditors play in this situation, right? So to sum this up, we can now say, or we can define the following terms. Stewardship. We just saw stewardship is the responsibility that the managers have, or the directors have, for the management of resources. Remember, steward is someone who's responsible on someone else's behalf, and they are responsible for the shareholders or the owners. Secondly, what's the purpose of an end of year audit? So the end of year audit is basically a check on the financial records of a business by an independent person. Remember, the qualification of independence is very important, and this can be tested in the questions as well. All right, and they have to ensure that the records show a true and fair view. What do I mean by true and fair view? So we can just understand that over here as well. True and fair view essentially means, in this case, that the statements that have been presented are free from any misstatements, they have been presented faithfully, and they show the true picture of the firm, right? So talking about material misstatement. So for example, let's say there was an employee who took $5,000 from the accounting records, but no one accounted for that. Now, that might be a small misstatement or something that is missing, but the auditor does not have sufficient time or resources to look at each individual transaction over here. But the auditor will be responsible, or the auditor should form an opinion based on the overall picture or any material misstatement. For example, $10 million are missing from the books. That is a material misstatement, right? So the auditor can only take few sample transactions to determine or form his opinion, which we will obviously discuss later. But the true and fair view means that the auditor has to give an opinion that he feels that the financial statement does not have any material misstatement, has been faithfully represented. So the management hasn't tried to bias the statement, hasn't tried to manipulate any accounting data, and the statement is in line with the company law or the taxation law. So the owners can have a true picture over here of the organization, right? So that's the role that auditor will play, or the year-end audit will play, and that's the process of stewardship. I hope you guys understand this diagram really well. So this diagram summarizes the situation of what stewardship is and what is the role of an auditor. So in the following video, we'll discuss the role of auditor in further detail.